turn it over to the
Want to pick
professor
up
and
the line
then.
of the stairs, please?
Great. That started.
All right, Ryan. This is a webinar. It's different than our usual discussions.
Hey, bud. All right. Welcome, everyone. It is October 28th, 2024. These are the Morgan State seminars. The Linux Foundation Decentralized Trust works with Morgan State, the Fintech Center at Morgan State, on a number of events like this, where we're able to bring subject matter experts, people in the field, people who are doing the work in decentralized technologies, to the Morgan State community and the greater community. This is the internet. Everyone's going to be able to see this. And today we're really thrilled that James Loprofito from Kissmetrics is able to join us. He's going to talk about Bitcoin and Ethereum ETFs. This is an hour-long session. If you have questions, please put them into chat. We're going to have enough people that it's too many folks to have doing verbal questions, so we'll do the questions in chat. I'll be monitoring the questions and helping James see what's there while he's giving his presentation. And we're pretty excited for this. So thank you, James, for joining us. Real quickly, LF Decentralized Trust, the flagship organization for the development and deployment of decentralized systems and technologies within the Linux Foundation. We do have an antitrust policy, and basically the Linux Foundation antitrust policy, because we could have competitors and industry players all at the table. That's why working with the Linux Foundation is so valuable. It allows us to create neutral, safe space for organizations to talk and work together without the risk of antitrust. If you have any questions about these matters, please contact your company counsel, or if you're a member of the Linux Foundation, feel free to contact Andrew Updegrove of the firm Gesmer Updegrove LLP, which provides legal counsel to the Linux Foundation. Next, we have a code of conduct. I'm going to be sharing links right after I hand over the mic to Professor Emdad. But our code of conduct can basically be summed up as be excellent to each other, be kind to each other, listen to each other's points, be happy to engage, but also no jerks allowed. We want this to be a great session and a great way for folks to learn. And we cannot be more thrilled to be working with Morgan State on this. And lastly, get involved. Open source only works with people. There's no magical box that makes open source. We need folks contributing their ideas, their knowledge, their code, documentation. So we have lots of ways to get involved. What you should expect as a contributor, as a member of this community or any open source communities, you should expect to be treated with respect. You should expect to be treated as a peer and an equal. And you should expect, if you're going to help out, to help out. And we cannot thank you enough for joining this session. But I'm going to be sharing the links for getting your LF account, checking out the code in GitHub repositories for the Linux Foundation, Decentralized Trust. You can search for open bugs. One of the best ways to do that on GitHub is look at issues, then look for good first issues, which every community should have a good first issue to let folks get onboarded. These are not the super hard tickets. It's the ones that get you on, get you into the system. Check out the contribution guidelines, find meeting infos and working docs and more on the wiki, and join our communications channels. We have a Discord, Linux Foundation Decentralized Trust. We have mailing lists for all of our projects. We also have special interest groups where folks are getting together to talk about topics, not necessarily the code, but implementations, use cases, actual executions in the market, things that are in production. So, and with that, I'm going to stop sharing and turn it over to Professor Emdad.
Okay. Thank you, Sean. Welcome to the 24 webinar series offered jointly by LF Decentralized Trust, or LFDT for short, and Morgan State University's National Fintech Center. We want to express our deep appreciation to Sean Bohan and to the LFDT team for their constant support. They've been working with us, supporting us in different webinars and different events for several years, and we are grateful for that. Also want to thank James for giving us an hour of his time today to share his expertise in this area, which is very important to us, and to the crypto community understanding Bitcoin and Ethereum EFTs. The National Fintech Center's mission is to build capacity at not only at Morgan State, but at 65 other HBCUs that are part of our network nationwide. We provide various programming and events for faculty, students, administrators from all these universities, and we're unique in that mission in the country. Please visit our website at fintech.morgan.edu for programs and events information, and also visit the LFDT's website for their extremely informative information and programs and events that they have for you. Thank you. Enjoy the webinar.
Thank you, Professor Ramdad and Sean, and of course the Linux Foundation. For you guys that may not know in the room, the Linux Foundation is one of the longest standing open source communities in the world, which is obviously democratizing access to technology in all the right ways. The Hyperledger Foundation is that segment of the Linux Foundation dedicated to distributed ledger technologies, which encompass not just the buzzword blockchain or crypto, but also other types of transaction networks that I would say follow the principles of decentralization, which we can get into. But I'd first want to just highlight the fact that you guys are getting an interesting look into the world outside of the typical academic realm, which I think is critical, at least as far as my experience goes, in not just learning about how the world really works from a non-theoretical standpoint, but also just stepping out of your comfort zone a little bit and getting ahead of where the world is going, because it's moving so quickly. So with that, I will share my screen and introduce myself. It should be fine. Let me know if you guys see the screen. It should be my PowerPoint there. Does everybody have a good view of that?
Jim, we can see your screen. It looks good.
Okay, great. If it's too small, I can mess with it, but I purposely kept it big in general because I'll do a lot more talking than you will reading. So as you can see, the focus of the conversation today, everyone, is the idea of the Bitcoin, BTC is the ticker, and Ethereum, ETH, ETFs. ETFs stand for exchange traded funds. I would argue that the word fund is a misnomer in the case of both Bitcoin and Ethereum, and that they have been classified generally as commodities, which means that they're taxed very much like property, or even a good analogy would be real estate, in that you have the typical capital gains tax that would be applied to them as commodities. And just they would be taxed the same way as ETPs, which I think would be a better descriptor of them, since they are individual assets, not groups of assets pooled into a fund. That's a story for a different day. But as you see, I titled the presentation "A First Principles Approach to Decentralized Identity, Assets, Custody, and How They Can Solve for Rent-Seeking Behavior." And I don't know if Sean has brought this up to you guys. I'm sure you know, but he's working on something called the Open Wallet project at the Hyperledger Foundation, which seeks to make open source libraries and code repositories such that there's the potential to develop open source, self-custodial, maybe even non-self-custodial, Sean, correct me if I'm wrong, wallet infrastructure, such that it is interoperable across tokenized networks. Sean, please feel free to jump in and again, correct me if I'm wrong or speak better.
No. You're in the right direction. The Open Wallet Foundation is a neutral home for digital wallet technologies. Some of them are related directly to identity and verifiable credentials. Some of them are related to currencies, whether they're central bank digital currencies, whether they're other forms of money. So, but 99%, Jim, you get, if I were a professor, you get it at least a B plus, at least a B.
That's my range. So that's great.
Thank goodness I am not.
So, first of all, what's most important to address here is the underlying assets in these ETFs, right? And why they exist in the first place, and what sparked their creation. And I think it's important to do a bit of a deep dive on Bitcoin and its genesis and why it exists and what it means. Bitcoin is very interesting for a few reasons. I listed some of those adjectives at the bottom of the page here. It was the first demonstrable proof of concept for an immutable ledger that was public and redundant and therefore very difficult to destroy or censor. And that is the idea of a decentralization, meaning that there's many copies of the same ledger, such that it's very difficult for any one person or group to destroy it. And that public perspective and degree of transparency is so far, it was not a thing until Bitcoin proved it. And that underlying technology that enabled Bitcoin is amongst other things what we would call asymmetric cryptography. And the difference between symmetric keys and asymmetric keys is that with the symmetric key, you're essentially trusting a third party to maintain access to something, a copy of your key to access an account or something that stores value potentially. With asymmetric keys, you can actually entertain, if not engage in the responsibility of custodying your own assets. And it's very important to mention because, again, Bitcoin proved this concept, but in the case of an ETF, you, by definition, are not custodying this product. Someone else is. And so you might ask yourself why that may be the case. In this instance, I think it's very easy to chalk it up to a very simple premise, two simple ideas, actually. One is that asymmetric key management, so managing your own wallet, can be very difficult. It proved to be so in the early days, especially of Bitcoin. And feel free to live fact check me on this stuff because these are numbers I'm recalling from memory. But I think something like 17 to 30% of the Bitcoin supply has either been lost or been destroyed because of people's inability to manage their keys or lose them. So it's an important notion to understand that, especially in the early days of crypto and even now, and I use the word crypto loosely, managing your keys and your assets has not been an easy task because of the way that keys are generated. So the way that keys are generated, which essentially represents what you would call a bank account, right, of some kind, that would be the analogy, is that there's a degree of entropy from which you can draw random number generation. And that random number generation first derives your private key. From that is derived your public key and then your public address. Your public address is like a bank account number. Anybody, if you gave it to them, could then send you Bitcoin by creating instructions on the network. And so this threat of self-custody is very interesting. And I call it a threat because it's a direct enabler of disintermediation within the consumer banking sector. And it is yet to be fully, I would say, reconciled with its potential. And we could talk more about that, but it is the innovation that allowed for Bitcoin to make the waves that it did. And so, historically, what is the incentive for someone like BlackRock or Coinbase or Franklin Templeton or these large institutions, financial institutions, to offer an ETF especially when you yourself can just as easily go and buy it and custody it on your own behalf, or for a small fee on, say, a centralized exchange where there are other sets of risks. And historically, the answer would have been commissions, right? The money that they earn from custodying something or transacting in something, right? That's kind of how Wall Street works. You pay either a fee for someone to custody your assets or to trade them on your behalf. And what's interesting about that is the idea of fractional reserve banking, right? Currently in the United States, holdco banks are required to maintain 10% of the assets in deposit as liquid instruments, right? And it's just an important thing to understand when it comes to global liquidity, counterparty risk, what we would call knock-on or cascading effects in say a black swan event, especially given the interconnectedness of the global financial world. Obviously, the United States banking system is different than the rest of the world, but there's a few things that every country's banking system has in common. For the most part, one of them is SWIFT, which is the international set of rules and standards and operating system by which money is transferred across banks, and the intermediaries required to honor the regulations and laws of each jurisdiction through which money travels. And that system has been in place for quite some time. SWIFT was built on, what many would argue was an outdated programming language called COBOL, and I think it was in the 70s and 80s that it was built. But the entire global banking infrastructure relies on that set of rails or transaction infrastructure for money transfer, value transfer to occur. And so there's this kind of spider web of banks and intermediaries, and most importantly, these things called correspondent banks, or the correspondent banking system, to allow for transactions across borders. The interesting thing about Bitcoin is that it inherently solves that problem. And so these fees, and I'll use the example of remittances as one of the most potent, can be pretty aggressive. For example, the largest remittance corridor in the world is the diaspora of Saudi Arabia, and there's tens of billions of dollars are being transferred in and out of Saudi Arabia on an annual basis. And the fees, if you use the program or service like MoneyGram or Western Union, can be anywhere from 2.5% to 10%. So in my opinion, that is rent-seeking behavior, especially when an alternative exists that is much cheaper. So just by virtue of this idea of self-custody and peer-to-peer transaction networks, philosophically, academically, theoretically, these transaction fees, along with custodial fees and many others, and you could go down the list. There's ATM withdrawal fees. There's Forex transaction fees. Many of these should, over time, essentially degrade to near zero. And so this innovation of asymmetric cryptography and the ability to transfer money from any single entity in the world to another without an intermediary or correspondent bank, say, is the innovation. Beyond that, there's something that's very important to understand, which is that all of those transactions are supported by this broad network on the SWIFT system and the international banking system, which has a lot of administrative overhead. And the other innovation that came along with Bitcoin as a blockchain, lowercase b, is this idea of triple entry ledger accounting. And because there's these redundancies in ledgers, it's very easy for there to be a record of transactions that is, again, ethereal in nature transparent to a degree, right? If you understand this idea of pseudo and anonymity, which you should read about in the Bitcoin white paper if you haven't yet, which allows for the automation of accounting and financial administration at scale. That really is probably, I would argue, short of introducing the idea of AI, one of the biggest cost savings and efficiency captures in terms of innovation in the last 20 years. So it's super important to understand that. This slide goes over Satoshi Nakamoto's Genesis block and the origin of Bitcoin. And we don't know who Satoshi is, but inscribed in this Genesis block is a caption from a bank article in 2009 where it says the Times, the Financial Times, I believe is the periodical that this was printed in, but it said Chancellor on brink of second bailout for banks. And so what is Satoshi really implying there? The implication is that fractional reserve banking can lead to these black swan systemic events that have a cascading effect on global liquidity and in these places where power can go unchecked with respect to the creation of money, monetary policy and supply, he's making this reference to. There's this potential to have greater volatility and asset bubbles over time. And so this brings this idea about of what we call hard money, or Bitcoin having a very finite supply of 21 million Bitcoin, which is important because there's no inflation, right? I'll let you guys ask questions about inflation if you haven't already studied it, and we can talk about that. But the idea is that because nobody can manipulate the supply, you always know that it's fixed and there's no way to create new Bitcoin. And because of that, it's very difficult to manipulate its price, and its price is only affected by demand. And the origins of Bitcoin and the infrastructure that supported it are extremely intricate, relatively secretive. And as you all know, we still, despite HBO's documentary, don't know for sure who invented Bitcoin. So I'll leave it at that for now. Let me just make sure. Yeah. So Nakamoto owns between 750,000 and 1.1 million Bitcoin. When it reached a value of 68,000, its net worth would have been up to $73 billion. But what's important to know is that Genesis block has not moved, right? Which I think is very interesting in and of itself. And there's a distinction to make between, and I'll get to Ethereum after this. There's a distinction to make, of course, between Bitcoin, the asset, as this digital hard money gold, lowercase b, part of my balloons, and the network itself. Yeah, please ask questions, guys. I'd like to make it as interactive as possible. Lowercase b, Bitcoin, the asset, acts like digital gold, and it exists on the uppercase B Bitcoin network as a token standard. However, there's approaches and ways such that the Bitcoin asset can be represented on other transaction networks, such that it doesn't only have to survive on the Bitcoin network itself. That said, because of the simplicity of the Bitcoin network and its proof of work consensus model, it has been old reliable in the sake that it's never been hacked. There are security vulnerabilities on the network itself, what's called a DDoS or 51% attack, where if you were to control 51% of the nodes on the network, you could theoretically destroy it or manipulate the underlying code that governs the network. That said, it wouldn't be in your best interest to do so, given you owned the asset. It started and continues to be mined and will be mined to 21 million Bitcoin. And the concentration of mining power is a very important idea as well. We're going to talk about distribution of Bitcoin because it's a critical idea. But the idea that everybody should be able to contribute to this network and own a piece of Bitcoin, although it is true, is also an important topic to understand alongside the other cons or negatives that people assign to the attributes of the network, including the energy intensity that is required to mine Bitcoin. Distribution is another problem, in my opinion, with Bitcoin, right? Because despite anyone's ability to buy it and it being an inflation hedge analogous to gold, you still have to have the money in the first place to be able to buy it, right? So these places in the world, most recently Venezuela, Argentina, El Salvador, these places where corruption and government manipulation of money has been an issue. You could argue that it's difficult to solve the problem by just buying Bitcoin because you still have to have the money and value to buy Bitcoin in the first place. Yes, there will be a recording. And so the network itself is the thing that hosts Bitcoin as an asset and theoretically always could and should, right? But there are security concerns like the ability to break the encryption. Bitcoin is encrypted by an underlying algorithm called SHA-256, which is known to have been invented by agencies within the United States government, State Department, CIA, NSA. They have a list of acceptable cryptography standards such that it cannot be broken. The idea with SHA-256 as an underlying method of security is that no matter if you put the same input in to this algorithm, you will always have the same output. However, you cannot take that output and retrieve the same corresponding input unless it's very difficult to break. The argument then becomes that quantum computing and its computational power at one point may be able to break the underlying consensus mechanism that secures the network. And the argument is that either one, that will not happen, or two, the consensus algorithm can be upgraded based on votes as governed by constituents of the network and the proof of work consensus and governance model. So that's up for debate. It seems like there can be a quantum resistant hash function and upgrade to the consensus algorithm such that that's not a concern and hasn't been yet, hence the value of Bitcoin sustaining itself now. And so here, I'm talking about why Bitcoin itself is valuable, which I've touched upon already. I think a very important analogy is to relate Bitcoin to this idea of its finite supply, but also that the energy required to compute and maintain the network should be limiting, in that energy is, at least now as we know it, not as abundant and is itself a form of currency that relates to Bitcoin. This is Michael Saylor, a very famous Bitcoin investor's opinion and philosophy. He's become very rich off of maintaining this philosophy through a publicly traded company, which is another way that you could gain exposure to Bitcoin if you were so interested without taking possession of it. And so, Bitcoin gets this negative perspective, not just because of its distribution, but also this idea of Ponzi-nomics. Ponzi-nomics refers to this idea that the first person to buy Bitcoin has the most to gain, right? So there's an incentive to purchase Bitcoin early if you agree that in the long run, this is going to be the hardest money, right? And so that it's an interesting concept to understand, but again, just think of it like digital gold. And the other again negative accusations are that it's so energy intensive that it's destructive to the environment, and there's arguments on both sides of the aisle there as well. Yep. I'll get to that, Ali. I think the most important thing would be volatility from a traditional investing standpoint. And so at the bottom here, I don't even remember writing this, to be frank with you, so I'll just read it. Hypothesis: programmable money and AI applications, along with potential massive advancements in computing speed like quantum and ubiquitous bandwidth, will likely eclipse the value of implied tokenomics inherent in the hard money thesis and make the concept of money irrelevant because labor, time, and energy as inputs will also be irrelevant. That's an accidental parentheses there, but I'm making the point here that digital gold and the representation of value is an important thing when money and value and stuff that we consume itself is finite. But what happens, for argument's sake, when general artificial intelligence solves the problems of abundance and potentially resource reallocation to its most efficient use, assuming that we can harness some type of infinite energy source like the sun, right? At that point, hard money becomes kind of irrelevant. Money itself becomes irrelevant. So I'll just leave that as a thought in your head. Yeah, and this is kind of the joke about Bitcoin's distribution and that I was alluding to earlier, in that the common econometric that we use to measure the difference in wealth as it's measured across the world is called the Gini coefficient. And the Gini coefficient in recent times has been expanding, meaning that the poor are getting poorer and the rich are getting richer, which is one of the inherent Pareto effects of capitalism, broadly speaking, but with money generally, especially because of the idea of the ability to invest, right? You have your net present value of money, which invested over the long time, or over a time period, right? It has a return, right? And I should probably, I don't know if I'm mirrored or not in this video, but you guys, if you haven't yet, you will learn about something called the capital asset pricing model. And if you imagine an x-axis and a y-axis, the return over time, right, gets higher because the longer your money is at risk, the higher you expect your return to be, right? So there's the what we would call the average annualized return of the S&P 500, which is a diversified portfolio of stocks, which equates to about 10% a year on average. And so that is going to be a little bit more volatile over time than, say, treasury bills. A one-year treasury bill is what we would, assign a very low risk to, right? Where cash is the least risky. You move up this continuum. But the thing with Bitcoin is that, at least in recent history, it's super volatile, right? That volatility, which the question was asked, well, what risk is there to an investor? The risk is that volatility and you not being able to withstand it in your portfolio. So on the capital asset pricing model, you have cash, money markets, T-bills, treasuries, bonds, and then stocks, and then all the way up here are the super volatile assets like historically Bitcoin. The argument is that over time, because the supply is fixed and demand should increase, assuming that everything stays as it is, Bitcoin's price over time should stabilize, making it look more like a store of value and less like a risk asset. And right now, it's trading much more like a risk asset than a hedge against inflation or a store of value like gold. And historically, that's absolutely been true. You can see that with its price movement, with rate cuts. So, when when there's more money out there, there's more money to take risk with, but your money is also debased at the same time, right? So asset prices reflect that. And Bitcoin is an asset in which, in the recent past, has behaved more like a risk asset with a lot of volatility than like something like gold, which would be historically a flight to safety asset. And so that's an important idea to understand. And so we've spoken a lot about Bitcoin. It has its own network, its own asset. That asset can be replicated on other networks. An example of another network, I think it's second in market capitalization now. It's important to understand this concept. Very important. Bitcoin itself, on the surface, looks very expensive. It's trading, I don't know, it's in the 60,000s right now, right? But because it can be fractionalized beyond the decimal point, I believe, to 14 places, anybody can buy any amount of Bitcoin, right? You could buy a penny's worth of Bitcoin. There's a term called a Satoshi, which marks, I think, 1/100th of a million of a Bitcoin or something like that. And that represents something like a penny, right? It's a denomination that people can understand, because, as you know, it doesn't have to be fractionalized the way that a stock has to be split in order for it to be accessible to somebody with lesser money than the cost of the actual asset, because it is fractionalized. So it's an important idea, especially with respect to the psychological pricing of things. And you could talk about purchasing power parity and value, and the ability for currencies to buy, and floating exchange rates. We could touch on that if people have questions on that. But it's very important to understand the pricing of things and how prices move in relation to other assets and currencies. But it's also important to note that Bitcoin is not legal tender, right? If it looked more like money, or was accepted as legal tender, wouldn't be taxed the way that property is taxed, and its utility would increase dramatically. So it's a very important idea is to distinguish these assets from dollars, right? Because dollars aren't taxed the same way that property is taxed. So then we can talk about Ethereum a little bit. Ethereum, again, the largest transaction network by volume. I would say it's probably it definitely has the largest developer network of any public permissionless blockchain. In recent time, it migrated from a proof of work consensus algorithm to a proof of stake algorithm, meaning that people who lock their assets in the network to help secure the transaction feasibility on the network are given a reward. And so it's what's called staking. You stake your ETH, which is the ticker of Ethereum, or the asset on the Ethereum, or native to the Ethereum network. Similarly to Bitcoin, Ethereum is the currency by which you must have and spend to transact on the network. But it also serves other purposes, as does the network itself. What's interesting about Ethereum is that, similar to Bitcoin, its supply, right, is programmed. Historically, it might have been slightly inflationary, as in it would increase over time. Recently, there was an EIP, or Ethereum Improvement Protocol, such that it might make the gas token itself, or the underlying asset, deflationary, meaning even finer supply, like a decreasing supply. But again, the important things to understand here is that it's not treated as legal tender, which means you can't just go and pay a merchant with a money transmitter license to buy something for it without having the tax implication of liquidating that asset to, say, cash, right? Which again has a cost associated with it. It's very important to understand. And as I'm saying here, governments control merchant acceptance of assets in exchange for securing the global financial network, right? The problem and the argument that Satoshi made is that the centralization of institutions allows for the controlled manipulation of monetary policy, which allows for this slippery slope of the debasement of money. And the solution to that is the hard money of Bitcoin as gold, which you can possess yourself and nobody can take from you or alter in any way. So it's very important. And then we talked about Ethereum as a network. It's commonly referred to as the Ethereum virtual machine because of this ability to deploy what are called smart contracts, which I think are a misnomer in that they're neither smart nor necessarily are they contracts, but they're more like a trigger for an automated execution of a transaction that may be affected by the observation of something that the network can see through what we call a excuse me, I'm looking for the exact terminology. Sean, help me out here. An oracle, and there's lots of examples of this happening. But because of the ability to automate transactions and program transactions, these networks can do much more than just facilitate a simple transaction from party A to party B. And because of that, Ethereum and the large commitment of developers in an open source community, it has a lot of potential as a network. Bitcoin has struggled in this regard in that it is completely open source. There's no centralized institution behind it organizing its development. And so there's this very important idea called the trilemma, which is the trade-off of these transaction networks between throughput or general speed with finality. Security is the second thing, and decentralization is the third, meaning how decentralized is the network and the nodes that operate and maintain them. And there's this inherent trade-off between the three because a network will be inherently slow if it's secure and the block space is limited per epoch of time or a block that's printed on these redundant ledgers. And so because of this trilemma, there have been proposals or introductions or innovations or solutions to solve for it. One of those is what we call layer twos. Layer twos are essentially networks or states of record that sit on top of a layer one network that can either store more transactions and kind of compress them and print them to original L1 network such that you can fit more transactions into a smaller amount of time or block space because that's limited by definition. Lightning Network is the layer two that many had hoped would solve for at least part of the trilemma on the Bitcoin network, but it's been a very difficult task given that all of this contribution in terms of development is open source. And so other networks have had the opportunity, like Ethereum, to essentially catch up to the value and utility and long-standing security of the Bitcoin network because of its ability to innovate within an open source permissionless group of development and and contributions to the network through governance proposals like EIP 15519. And so I'm just making the argument here that essentially the Ethereum network in utility and even the asset itself could outperform Bitcoin for these reasons. Now we can talk about the actual ETFs themselves, since we've gone over a lot of the underlying assumptions that comprise the assets. And so, as I said earlier, ETF stands for exchange traded funds. In this case, again, fund is a bit of a misnomer in that they're single assets, not funds. They're not actively managed. It's literally a one-to-one representation of the asset itself. And again, the reason why they may exist in the first place, institutional distribution through financial institutions. It made it a lot easier for institutions to buy Bitcoin instead of self-custodying it or trusting a third-party custodian that they may not be accustomed to trusting, right? The whole point of this is trustlessness, right? That you can take custody of this asset yourself. That said, because managing your keys in that way that I described earlier is difficult for an institution that has a lot of value at risk, they may not want to have to deal with any of that because of the threat of loss. So that's really, I would argue that and regulation around it is the biggest reason why the ETFs exist in the first place, is centralized distribution, simplicity of custody, and legislation for institutions to be able to touch these assets, because a lot of these institutions are much less risk inclined than, say, someone who's gambling on the price of Bitcoin or Ethereum. Now, the interesting part about all of this is that having a centralized custodian is counterproductive to the original idea of self-custody and being able to take ownership of these assets, right? So there's an argument that you're re-centralizing the very thing that that made it valuable in the first place. However, as it's been plainly obvious, one could argue that there's been a new price floor for Bitcoin because of this enhanced distribution, especially to institutions, which obviously manage more money than the combination of retail investors potentially. Yeah, we could talk about that. And so, yeah, let's talk about custody. There's self-custodial or non-custodial solutions where you really have to actively manage that set of private keys and never lose that long string of numbers, random numbers and letters, which comprises your private key, which can be reduced to, a mnemonic 12-word phrase or a hardware wallet or something that is physical in nature, which is a very useful way to store digital assets, in my opinion, especially because they can be backed up, right? There's ways to prevent loss if you lose one set of keys. There's many ways by which now you can safely self-custody Bitcoin. And there is also trusted institutions like Coinbase who will custody the asset on your behalf in its true form in their own wallets, but you will then have access to transact within that atmosphere while not having to necessarily worry about custody. I don't think that the Coinbase funds are FDIC insured. I have to double check myself on that. But insurance against loss is the thing that has been missing generally from self-custody because of the risks of you losing your keys or your inability to transact. So that's very important. I think one of the problems that Sean and the Linux Foundation and many are trying to solve for is this idea of self-sovereign identity or decentralized identity, or an identity by which you can be constantly anchored to your digital assets via biometric attachment or some proof of personhood, such that your control of assets rests solely with you, and is interoperable, maintains privacy, and has other features like, censorship resistance, which allow you to maintain and self-custody your assets in a convenient way. To me, that's a big element that I believe is missing from what we would call the Web3 network of networks. Interoperability and token standards are another big thing that is now starting to see solutions in the real world, because there's a few different ways by which you can represent a token on a different network or can join networks. And it's very much a hodgepodge of solutions right now. But there's a lot of innovation in that space. But I would say one of the most important, still unproven, but likely to be proven pieces of technology are what are called zero knowledge proofs. Zero knowledge proofs are the ability to represent a set of facts or a piece of information or ownership of something to someone else without that person knowing what exactly that fact is or that piece of data is. And a physical example could be that if when I walk into a bar, I need to prove that I'm 21, they don't need to know, the bouncer doesn't need to know my birthday or my home address on my driver's license, but he or she does need to know that I am 21 years of age. There could be a third party that they trust who attests to the fact that I'm 21, like the US government who provides this document that I'm showing them that says that I'm 21, but they don't need to know my birth date or the justification of the proof, right? So that is a very important idea as well, which is something that will be, I think, made manifest, especially with self-custodial wallets. And I'll leave you with one more idea, which is that money itself will much more resemble data and information and other forms of value than what we know money to be today. And so your identity, your credentials, the data associated with you itself has value and will become tradable assets. And it's very important to think about this this blurring line between data as value information and money as assets and value. So I'll leave it to that. I think I probably addressed a lot of your questions. And the answer to your question, Michelle, is it depends on the situation. In many ways, the answer is no. If you lose your keys, they're gone. There's lots of examples out there that you could read about. Definitely Google that and you'll see some very funny stories. But I'll definitely open it up to a few questions if there's any more for the last 3 minutes. Or Sean, maybe you want to have some of that be surfaced and you can pose something for me to leave the group with. But otherwise, hopefully that was a good explanation for everybody.
Absolutely. Hang on one second. So yeah. So Professor Mdad had asked, do you foresee other cryptocurrencies being included in ETFs? I'm more concerned in this question that my favorite part of his question is what criteria might they need to meet in capital markets to be included in ETF. There's generally some rationale that exchange traded fund had someone guiding it saying, well, we are a fintech ETF, but we only do financing for the healthcare industry. And you can get really down deep in the sort of categorization and where this is going. So I thought the second part of the professor's question was great. Like, what's the criteria other cryptocurrencies would need to meet?
Yeah, so the interesting part about that is there's different classifications of tokens as assets. And the governing bodies, especially in the United States and around the world, they all have different criteria, right? So the SEC, instead of establishing, well, the problem is that there first of all, there wasn't a single regulatory agency that defined any of these things. So there was actually kind of a bit of a fight between the SEC and other governing bodies and regulatory bodies and legislative bodies to define even what the rules are, right? So the Howey test had been essentially named, and it has been used historically on Wall Street as something that would define an investment contract or a security. In the case of Bitcoin and ETF, they're classified as commodities. So things that resemble and how they're sold is probably the most important thing, as well as there being a centralized issuer. Bitcoin had no centralized issuer besides Satoshi Nakamoto. Ethereum is very similar. These are essentially currencies that are generated out of protocol written to open source code. So there is no single issuer, holder, someone that wrote this investment contract by which someone, a retail investor, might buy from a singular entity, right? That's one, measure of the Howey test. There's a few measures. And so anything that looks like a commodity that did not have a centralized issuer or something that resembles an investment contract may meet the criteria, but there's also these investor protection mechanisms that these agencies that allow or approve of, like the SEC, the ETF, to be publicly listed. And that comes down to security, custody, the properties, but of the asset itself, but most of it revolves around whether or not it looks like a security token or an investment contract, or something like a commodity, like gold or Bitcoin. Other assets that are on docket are very similar to Ethereum. The Solana network and transaction fee token is one of them. But size is also very important, right? Because what the SEC doesn't want is people to be exposed to assets that are so volatile and dangerous that they become, they have a severe or dramatic loss in something that they don't understand. So Solana, is another large market cap network and token that may have reduced volatility over time and have the broad appeal to be put into an ETF.
Awesome. If you have a question, please post it in chat and we will ask it. I've got a question for Jim.
Yeah.
I think ETFs have been something that the industry has wanted for quite a while. In your opinion, again, as a subject matter expert, do you see the rise of Bitcoin Ethereum ETFs as a signal of maturity in this space, or do you see it as a expansion of access? Like they have now made this type of asset class more accessible to people who are not going to run they're not going to run a ledger now, hardware wallet. They're not slapping a MetaMask on every single browser they've got. Is this going to open it up to more folks who have not had either the technical or the conceptual frameworks to work with these asset classes before?
Yeah, absolutely. It's definitely both. So Mohammed Al-Iriani is one of the biggest passive income portfolio managers in the world. I think it's PIMCO that he manages. He said very clearly, until these assets look less like speculative assets that have that mark of volatility and have broader adoption and a more predictable rate of return, larger funds cannot access them. But there's kind of these stepping stones in between that you need to have adoption for volatility to smooth out, right? And so the distribution channels themselves and the ability for others to adopt them, like you said, Sean, who may not otherwise take the risk of self-custody, have existing mechanisms and operating systems and things that they don't want to mess with or touch or break. The ETFs become an accessible means by which they can participate in the economics of the asset, right? Without necessarily having to worry about custody or the technical issues that might accommodate it. And so to me, yes, it's absolutely a stepping stone for broader adoption, not to mention the idea that most money that is investable is not managed by retail investors. it's mostly managed by institutions. Like all of the pension funds, I speak mostly to the United States because it's the market that I know the best. Most of your pension funds, most investable assets that are public assets or assets of the end user or individual retail users are still in management under an institution. If it's too risky for that institution to take ownership of that asset, for any reason beyond volatility, they're not going to do it, right? There's all sorts of legal repercussions.
Sure.
And so the one idea that I'm slowly losing track of, the important idea here is that because of the existing structures and legalities, there's limitations to how these assets can be adopted at an institutional level, but the vast majority of the money is in institutions, and that it's what's strange about it is how powerful the network effects can be with with both the networks and the assets themselves because of the tokenomics and their design, right? If everybody agrees, and we do this with our own money today, right? The greenback, the US dollar, we agree is the world reserve currency. Why? Because the United States protects it. How do they do that, right? There's a variety of ways. It's a conversation for another day. But the more people mutually believe in the value of something and its ease of exchange, inherently it becomes more valuable, right? So the network effects are almost amplified by the fact that many people can transact in the same thing easily. So that access, to your point, Sean, is a major stepping stone in broader adoption for sure, both within retail or institutional.
Awesome. And I think we're pretty much at time and out of time, but I just want to make a point. I am Mukun, your question is perfectly fine. And Mukun asked, what would be the recommended method for investing Bitcoin, such as when should you invest and what interval? Unfortunately, we can't answer that question. We cannot give investment advice or recommendations. If you listen to podcasts in this space, every single one will start with, this is not investment advice. This is not investment advice. So we can't answer that, but there are lots of resources out there on Discord and the web with folks sharing their trading strategies and what they do and how they do it. But that's really not something that we could answer in this forum. It would not be appropriate. But thank you for the question. I would like to say thank you to Jim for such a great presentation. Solid and informative. I do not mind the simplicity of your slides, sir. I do not think you should slam them. I think they're great. I'm going to get a PDF of these slides. I'm going to put them on the wiki along with a link to this video and the links that I've been sharing in chat. I would like to ask Professor Mdad if he'd like to say a few words and then turn it over to Jim for the last word.
Thank you so much, Jim. It was very informative. I'm sure that the recording of the session is going to be very popular with our professors and our students, as I see many of them on the list of attendees. We posted on our website as well. I do appreciate your sharing your expertise with us. And thank you, Sean, for helping us organize this event. Thank you.
Likewise, thank you, Professor Mdad and Sean for inviting me and for all of you for listening. Thank you.
Awesome. Thank you, Jim. Thank you, Professor Mdad. I lied. I'm going to get the last word. Next Monday at the same time, we're having a session with one of the technical advisory committee members of the Linux Foundation Decentralized Trust. The topic is going to be blockchain interoperability. Peter is a fantastic contributor and software maintainer and thinker in this space, and he's going to share his knowledge around why blockchain interoperability is important, how it should be done, where you can do it, and if you have any interest in general enterprise blockchain interoperability, not specific to cryptocurrencies, absolutely be here next week. It will also be recorded. It will also be put on the wiki, and we'll get the recording and the links and the PDF to the Fintech Center at Morgan State, who we are super proud to work with on this seminar series. I'd like to thank everybody for joining us. Thank you so much for the questions. I have shared the links to YouTube in chat. I've also shared a link to the Wiki page for this session. I'm going to make sure everything gets up there, but I'm also going to put the links in the YouTube description in case, you know, hey, where was that thing? Someone said you can go back and check that. But once again, thank you everyone for joining us. Thank you, Jim, and thank you to the FinTech Center at Morgan State. Y'all are the best, and have a good day.